Every year, December brings an air of joy and magic. Some feel it due to the festive atmosphere, others for the holidays, or perhaps the gifts under the tree. But there are also those who wait December for a very different reason. An intriguing pattern in the stock markets. I'm talking about the famous Santa Claus rally. In this video we will explore together what it's all about, why it garners so much attention, and how you can make the most of it. Let's start by understanding what it is. The Santa Claus rally is a term describing a market phenomenon, often observed in the last days of December and first days of January, during which stock markets tends to perform positively. But what lies behind this trend? The reasons are manifold, and among the most common we find the window dressing. The window dressing is the act where institutional investors and fund managers buy well-performing assets to embellish their portfolios. In other words, they aim to improve the appearance of their portfolios in the eyes of investors. However, beyond the motivations, what truly matters is understanding if this bullish effect actually exists, and if so, how we can best leverage it. Let's move to the chart to analyze first and foremost the behavior of the stock market in December. Okay, in this chart you can see the Dow Jones Industrial Average from 1920. So let's take a look to the script. In this case, as you can see, there are only two conditions, one for entry and one for exit. If we are in December and the day of month is greater or equal than, in this case 1, then we will buy next bar market. In other words, we will go long on the first available day of December. For the exit, if we are in January and the day of month is again greater or equal than 1, then we will sell next bar market. We will use this strategy just to analyze the performance of December. Another important thing are the properties of the strategy. As you can see, I set a cash per trade of 1 million. So, per each trade, we will use a trade size of $1 million. This is just for a better position sizing, because actually the Dow Jones value is around 40k. Okay, now let's take a look at the performance. This is the stock market behavior of December. As you can see, we have a pretty good equity line, but in this case we can consider some outliers here in this part of the chart. So let's take a look to the total trades, and as you can see here we have a great outlier of around 200k. So in the next step of the strategy we can consider Dow Jones data from 1940. Just because we want to remove the outliers that refers to the 1929 crisis, the so-called Great Depression. As we have seen, December is generally a very positive month for stock markets, making it plausible that this Santa Claus rally really exists. At this point, to confirm this hypothesis, we will optimize the entry and the exit days to find a sort of time window in which the market tends to show the best performance. In other words, we will analyze which day of December might be the most advantageous to buy, taking advantage of the market's rise, and which day in January is ideal to close the position. For this analysis, as mentioned earlier, we will considering data starting from 1940 instead of 1920, just to reduce the impact of the outliers from a century ago that could distort the results. Okay, so let's optimize the entry date. And we can optimize with a start value of 1 to an end value of, for example, 30. Let's visualize this with a graph. And in this case we have to consider that the green line is the net profit. As you can see, we can reach the greater net profit if we buy on the first trading day of December. But I think that it's just because we can stay in a trade longer. So what I like to consider are the values here, in this part of the chart. As you can see, if we buy on day of month 14 or 15, we can reach great results. So in this case, let's choose 14, just because I don't want to take the exact optimal value. Okay, now let's optimize the exit date. Again, we can optimize it from a start value of 1 to an end value of 30, and let's take a look to the graph. As you can see, if we exit on 30, we can reach a huge net profit. But that's just because maybe there is a year where 30th of January was on Saturday. and the markets are closed on Saturday. So we stayed in the position for another year. That's because in this case I will not consider this value. But looking on the left part of the chart, we can see that there are great values around 6th or 7th as a day exit. Also in this case we can choose, for example, 6. Again, just because I don't want to take the exact optimal value. So let's choose 6. Okay, now you can see that we stay in the trade just for 2 or 3 weeks. So let's take a look to the performance. As you can see, we have a great equity line. It looks like this Santa Claus rally really exists. Now, let's take a look to the average trade of this strategy. And as you can see, we have around 100 trades, with a percent profitable of around 76% and an average trade of 19,000. What does this mean? This means that this pattern has produced a 1.9% return every year. Of course, if you consider the $1 million trade size. We can say that it's not bad if you consider that we stay in the position for around 2 to 3 weeks. In summary, we have seen that the Santa Claus rally is a very positive pattern. The rules are simple. Ideally buy on December 14 or the first trading day after that date and close the position on January 6th or again the first trading day available. In today's example, we applied this strategy to an index, which in itself is not tradable. We did this to gather as much information as possible and to work on a larger statistical sample. That said, you can decide to take advantage from this pattern, for example with an ETF or a stock market futures. And as always, I remind you, if you are interested in these topics and want more information, you can find several useful links in the description. And I wish you good trading.